Hello there, welcome back to the Property Activator program with AIN here on Thrive, and it's all about property investment strategies, but also making sure that we understand property investment, the landscape in South Africa, and also the different strategies that there are for you to take when it comes to property investment, and also which one is the right one for you. But before we start, please make sure that you have a notepad and a pen handy, as well as a calculator, because we are going to get to the point where we start running the numbers. Why is running the numbers important? With every property investment strategy, as I've mentioned in the previous module, is that we need to understand that the principles are more or less the same. What we also need to understand is that every strategy has its own approach and different checklists and ways to go about property investment within that specific strategy. Things that you need to understand, but also things that you need to be aware of, and also the marrow that you can squeeze out of that specific property investment strategy. All right, running the numbers are the fundamentals when it comes to property investment. If you do not run the numbers, you are going to end up in hot water. And that is something that you as a property investor do not want to see happen. Once again, we all have our comfort zones, and this is me asking you to be brave, take a bit of a risk, and step out of your comfort zone to understand that when it comes to property investment, there is risk. There's definitely a lot of risk, but also if we understand the risk, we can manage it. All right. We need to address the element of fear in the room. All right. How fearful are you? And sometimes fear can overpower us and we can feel overwhelmed. And I don't want you to get to that point. And that's why we're going through these modules to help you better understand property investment and the best way to tackle these opportunities, making sure that you end up whole and unscathed on the other side. All right, remember, those who do not dare will never ever win. All right, we need to take that step out of our comfort zone. All right. So, question. We have two types of people when it comes to property. Can you guess what it is? Two types of people? Do you know? Let me tell you. All right. Two types of people are people that buy property and then people that invest in property. I'm going to give you a few moments to just quickly think about this. What is the difference between people that just buy property and people that invest in property? Take a moment. What do you think is the difference between the two? All right, I've given you enough time. So what do you think? What is the difference? Do you know? Okay, all right, let me tell you. All right, the difference between the two people, both sides of the fence here, is people that buy property are people that are usually told it was a good deal. Someone else told them, listen, this is something that you need to buy. They haven't done their due diligence. Do we know what due diligence is? It's your homework, making sure that it makes sense. They did not run the numbers. What does that mean? Is it going to make sense, rand and cent? All right, they bought in their own names. They were hoping for capital growth. Yeah, get the property. In 10 years' time, you can retire. But they did not understand the implications of that specific property. And will there be sufficient capital growth over the time that they have that property? So the result of a person that just buys property is they often end up in a negative cash flow deal. They run out of affordability, they get stuck and confused and overwhelmed. And that's not where I want you to be. That's why I want you to know and think of yourself as someone that invests in property. So people that invest in property, on the other hand, are people that treat it as a business. It needs to make sense. It needs to bring you value or a return on investment. That's what we're looking at. All right. There are people that did their due diligence. They know how to do their due diligence. All right. They know how to run the numbers. All right. They are a positive cash flow from day one. Is it possible? Yes. We want to say that yes, it is possible. From day one, you make money when you buy that property. That's what we want. And they bought it in the right entity. So what is the result of this? The result is that they end up in a positive cash flow situation. they have extended affordability, and that they are confident in moving forward when it comes to acquiring property. All right, so I want you now to look at yourself not as someone that just buys property, but someone that invests in property from now on. Okay, what we do also need to understand is that in order for you to become a property investor and not a property buyer, you need to have a change of mind. You need to switch your mindset altogether. So when we talk about people that are investors rather than just buyers, we need to understand that what entity do you buy that property in? What is the business and tax implications? How do you run the numbers to ensure that they make sense? What level of due diligence do you need to do as a property investor? And also, you need to understand what you can do and cannot do with an OTP. We do know what an OTP is, right? An offer to purchase document. The document that you give, you sign from the estate agent to acquire that property. It's a legal document. Which strategy do you choose as a property investor? Where do you find the money for that deal? And also where do you find deals as a property investor? How do you run the numbers? How do you know what all the hidden costs are in a property transaction? And that's one of the things that most people get caught with. They don't understand the total picture when it comes to costs involved. All right, let's carry on. Let's go to number 10. How do you manage your tenants when you want to rent out that property? How do you look at refinancing? All right, how does it work? What about all the risks involved when it comes to property? All right, risks. When the interest rate goes up, how is it going to affect and impact you? All right, are you prepared for it? What is the true market value of the property? And what's the market value of the property specifically in that area? Making sure that you understand that. How do you scale your portfolio? How do you diversify your portfolio? And also zoning. Do you know what zoning is? All right, the different reses in terms of zoning, and also what does it entail? All right, those are sort of the different questions that you as a property investor, if a question is asked, you should be able to understand and respond. All right, if you don't know anything or everything now, it's okay. We are going to teach you. Remember, these 10 modules are really going to give you just a surface level understanding of what you can do and achieve as a property investor. We are with you all the way. We want to hold your hand and make sure that you make a success of your journey. But let's move on. All right. For every property investor, we need to get to a point where we lay down a great foundation and also a blueprint for you as a property investor. What does that look like? All right. Once you get involved with the AIN network and SAP, and we will help you to look at your own property blueprint, from planning to implementation and optimization. All right, what does it look like? So something like this. As a property investor, we want to get you to the point, number one here at the bottom left, we want to get you a point where there's a needs assessment. Well, what do we mean by needs assessment? It's really being that reality check, so to speak. All right, making sure that we understand your weaknesses and your strengths and your opportunities, but also getting rid of vagueness and making sure that your reality check is as true as possible so that we can know where to jump from. All right, that springboard that we're going to take that leap of faith from. All right, then we go to point number 2. We need to do a needs portfolio health check and a strategy for you to start with. It will help you get rid of uncertainty, but also make sure that it gives you the necessary insight in terms of your property investment journey. Then we lay down the blueprint, and this will be a document for you to give clarity in terms of your journey. What do you want to achieve? How are you going to achieve it? And what are the things that you need to be aware of in this journey towards property investment mastery, so to speak? All right. This blueprint will get rid of any lack of direction, and it will help you to get a sense of clarity. Then we move up. If we say we move up, we go to structure, making sure that you structure your property investment portfolio in the correct way. We need to look at tax, protection, and finance. In that way, we will help you to position it really and as optimally as possible, getting rid of any disorganization, any disorder, any risk anything that could possibly impact you. We want to get rid of that, but we want to give you a point of efficiency and protection in terms of your assets. All right, you'll see that there's a line that goes up and then it comes back again. And sometimes this step number 4 can be a bit daunting to us as property investors, because it means that things are actually now getting real. We're getting to a point of structure. But we want to get to a point where we need to move forward. And that's why this blueprint document is very, very important. So make sure that this step here, number 3, is really vital in your property investment blueprint. All right. Then what we're going to do is we're going to move from 4 towards 5, where we start doing that needs portfolio health check again and strategy, making sure that you change the needle where it needs to go. And it will help to get you to a point where you feel confident and not overwhelmed and uncertain or uninformed around the property investment steps or the purchase or acquisition process. All right. Step number 6 in the implementation phase. When you get to that point of signing the offer to purchase document, that you take action and you move forward fast, because you don't want to let that opportunity slide. All right. Most property investors feel a bit daunted and overwhelmed, and therefore they stand still. They just stagnate and they freeze. And we don't want you to get to that point. All right. So point number 7, we want to get you to a point where you are refining the systems. All right. When we talk about refining the systems, it'll help you to get rid of any inefficiency, and also it streamlines you for effective deal management and control. All right, now moving all the way to this side. All right, so when we look at number 8, deal management. So by this time in your blueprint, you will get to a point where inferiority is no longer something that you need to deal with. You are confident, you know what you know, and you are getting to becoming a master at what you do. All right, and therefore you can dominate the deal, making sure that you understand, negotiate, and arm wrestle when that deal do come through. All right, or presents itself. And then ultimately ending up at number 9, you want to just repeat and grow. We want to get rid of mediocrity, and we want to become really good at this. All right. And this blueprint is then set for you to understand exactly how you would like to start the process, making sure you've got a buying plan. How does it work? And remember, this blueprint is for beginners, but also for advanced property investors, to help them streamline their property investment process, their acquisition process, and also making sure that they understand the securities and the risks that involve, but also making sure that you get from that point of OTP to having a successful property investment portfolio, that it is structured in the right blueprint for you as a property investor. All right, so a bit of activity at this point in time. I want you to quickly stand up. Can you stand up? All right. Now I want you to introduce yourself and say, "Hi, my name is blah, and I am a professional property investor." And I want you to nod. All right, there we go. Stand up, and you're going to say, "My name is blah, I am a professional property investor." All right, that's what we do. So there we go. Stand up. And you are? Well done. All right. It's all about owning the process. When it comes to property investment and being an investor, you need to understand that you are the person that is going to make this possible. All right, no one else is going to do that for you, although we offer to help and support from our side as much as we can. It is all about you. You are the one taking action. You are the one investing in yourself, and you are the one that is going to make things happen. All right, good. Now, when it comes to property investment, there are 7 crucial rules. So the first rule of property investment is, do you know what the first rule is? Do you know? Can I share it with you? You make money when you buy. All right, that's it. You make money when you buy. Is it possible to understand that you can make money when you buy? Yes, it is. And you need to be in a mind frame that constantly tells yourself that when you do look at a property investment opportunity, that it needs to be cash flow positive from day one. All right, you need to make money when you buy. But to make that happen, we need to understand the process of property investment. What is involved and what do we need to look out for when it comes to property investment? And running the numbers is a crucial element for you in understanding property investment in your own journey. All right, so what are we looking at when we do say running the numbers? All right, it's as easy as the following. Understanding the different stages within the buying process and the property investment process. Whether you want to sell or rent out, we need to keep these stages in mind. All right, so stage 1 is the buying stage. What costs are involved there? Stage 2, refurb and holding costs. What costs are we talking about in stage 2? Do you know what holding costs are? Do you know? So holding costs are all the costs for you to hold on for you in that process of the property being renovated or getting ready in order to sell or flip or rent it out. You need to get some of the costs there are like levies, COJ, rates and taxes, etc. That's what we are talking about. And then number 3 is rent and resale. What costs are involved there? All right, good. So let's move on. So let's go deeper into stage 1, the buying stage. What costs are involved there? We call it capital costs. It's once-off costs that you are going to spend on getting that property. All right, so capital costs could be something like your transfer attorney fees, your transfer duties. Remember, there's no transfer duty on a property that you purchase below, do you know, 1.2 million. All properties below 1.2 million are transfer duty exempt. All right, however, there is still transfer attorney fees that you need to pay. All right, but you're not going to pay the tax, the transfer duty. There's bond attorneys involved. There's a fee for them as well. There might be a deposit, the outstanding rates and taxes in some cases, depending on the property transaction. If it's an auction, is there sheriff's commission involved? Is there a private auctioneer commission? What are we looking at? So you need to understand that you get the full picture in terms of once-off costs for you as a property investor to acquire that property. So this is stage number 1, and these are capital costs, and these are the once-off costs involved for you to acquire that property. All right, let's move on. When we look at stage number 2, refurbish and holding. All right, so there are costs involved like rates and taxes, electricity, the bond that you need to pay before you renovate it and put tenants in, refurbishment, levies, insurance. You've got building insurance, but also you've got life insurance by the bank. Sometimes they require you to have a life insurance policy as well while you are under their finance. All right, so these are like stage 2, the refurbishment and holding costs for your property investment journey, running the numbers. Let's go to number 3. When you want to rent or resell or sell the place or property, what are we looking at there? Okay, so stage 3, we're looking at the bond. While you are selling, you still need to keep the bond intact. All right, insurance need to be there, rates and taxes, levies, maintenance. We believe about 10 to 20% of your gross rent need to be put aside for maintenance. All right, management of the property. Are you paying management fees to a managing agent? And also, do you have a estate agent's commission that you need to pay when you do sell the property? All right, so those are the 3 stages and the relevant costs that you need to keep in mind when you are going through the acquisition and sale of a property. But what if I tell you that you could get rid of all the costs in stage 2, refurb and holding costs? Does that sound interesting? We're going to cover that later in one of our modules. So you need to understand how to do it. It's very technical, but it can also reap you huge rewards if you do it right. Okay, so what do we look at when we say running the numbers? We know that there are capital costs, we know that there are holding costs, and we know that there are resale and rent costs. All right, but other fundamental calculations are necessary for you to understand what would be a good indicator to buy a property or not. All right, because you want to get as max profit as you can from each and every property. All right, so with fundamental calculations, we look at how do you calculate gross yield. Gross yield is an indicator to help you understand, would this property be a good buy for you in your portfolio, or is it something that you need to walk away from? All right, and I'll show you how to do it. We'll show you how to calculate a cash flow for your property per month. We'll help you look at capital costs, what capital costs are involved per month, well, once off, and then also return on investment for a property. Are you going to make money in the long run on that specific property? All right, are you ready? Remember, you need to have your calculator, your notepad, and pen handy. All right, so let's get into how do you calculate gross yield. Remember, I said gross yield is an indicator whether you need to acquire the property or not. All right. So when you look at a property that you want to buy, this is the formula that you are going to look at in order for you to make a decision to get the property. All right. So gross yield is basically a simple formula. It's your annual gross rent, okay, divided by the property price times 100 is your gross yield, that indicator whether you should obtain or acquire that property. All right. So you take something like, let's say 6,000 Rand a month gross yield. So it means that it is 72,000 at the end of the year. So annual gross rent, meaning monthly rental times 12, that amount, divided by property price times 100. And then you'll get a percentage when you do that. If you score 15 and higher, you can go for that property. Below that, we need to understand it will affect you, and we would recommend that you do not take up that property. All right. So we need to understand that 15 and higher is a good indicator to buy and get the property. Below 15, 14.5, no. All right. 15 and higher, yes. Below 15, there's no way that you are going to get you that property. We recommend that you do not, you walk away. All right, good. Let's go to cash flow. We're going to come back to this. So relax. We are going to go through this again, and we're going to make it practical and give you some examples on that as well. All right, then we look at cash flow. All right, so cash flow means your monthly income, like your budget. Monthly income versus minus expenses, that gives you your cash flow. All right, your monthly profit, that is your cash flow. All right, so what does it look like? All right, so let's say, for instance, your gross rent is 10,000 bucks. Okay, so bond repayment is 6,000. Your rates and levies are 500. Management fees is 1,000 bucks, and your 1,000 bucks operating costs for maintenance and voids. Do you know what voids are? Voids are when your property stands empty. So we recommend that a monthly amount that you need to put away for voids to cover that should that happen. So in this case, 6,000 bond, 1,000 Rand for rates, taxes and levies, 1,000 for management fees, and 1,000 for maintenance and voids. It gives you 1,000 bucks monthly profit. All right. So that's a simple example of cash flow. All right, so we've done gross yield, we've done cash flow. Now we're going to look at capital costs. Remember, capital costs are those once-off costs and expenses. All right, so it is total once-off cost in order for you to purchase the property. Those are that transfer attorney fees, transfer duties, bond attorney fees, deposits, etc. All right, so let's look at an example of capital cost. So let's say you get the property for $1 million. So your transfer and bond cost is 40,000. Transfer duty, you don't pay transfer duty because it's below 1.2 million. And then your deposit, you didn't pay deposit. So refurbishment, you had to fix. So there's 60,000 bucks that you spent on refurbishment. So it's a total of 100,000 Rand capital cost, once-off cost for you to acquire that property. Clear? Simple? Fantastic. All right, we've done gross yield, we've done cash flow, we've done capital cost. All right, now return on investment. Will this be a positive return on investment in the long run? Okay, ROI. And how do we do that? All right, so keeping the previous calculations in mind, and I know this is a lot now, so it's okay. Take a moment. Breathe. Okay, good. Remember, gross yield is an indication whether you should buy the property. Cash flow is a formula that you use or a calculation you use in order for you to make sure that your property is cash flow positive. Capital cost is total once-off costs incurred on the purchase of the property. Now we're going to use these calculations in order to understand the return on investment. So how do we go about that? Return on investment calculation works as follows. Remember we had that annual net profit, that $1,000 on the cash flow exercise. All right, so divide that by the capital cost, the cost that you've put in. Remember in that case it was 60,000 times 100 gives you an ROI, gives you an idea of how much you can get back from this investment. All right, good. So let's break it down, help you understand. So we said our cash flow had $1,000 of monthly profit. All right, so you take that and you multiply it by 12. So in this case, it is $12,000. Are we good? Fantastic. Then you divide it by 12,000 by the capital cost. Capital cost were, remember, we said 40,000 on bond and registration costs and 60,000 on refurbishment. So that's $100,000 there. All right, so 12,000 divided by 100,000, okay, times 100, and it'll give you 12%. All right, so this then on the long run gives you an idea how profitable and at what return you can expect on this investment. And that's why we need to keep that 12% in mind. Remember, this has nothing to do with gross yield in the previous segment that we've done. All right, this is your return on investment. When you put money in a bank, you put it in the bank and you expect a certain return on investment. All right, so that's what we're looking at. It's the same idea. Now my question is to you, how much do you get standardly in South Africa if you put 100K in a bank account? What interest per annum are we looking at? That percentage are we looking at in South Africa? Do you have an idea? We're looking at roughly about 6% to about 7.5% in South Africa at the moment when it comes to putting your money, boom, in a bank account and you draw interest from it on an annual basis. All right, so when you put 100,000 in the bank, you will, after 12 months, you will get 6% back from that. So how much is 6% on 100,000 Rand? Have you done the math? Okay, so what we need to understand then is that if you have a choice to put your money into a vehicle that will grow adequately for you to become financially free or be fine with retirement, that ROI calculation that we've done on property is significantly higher. So why would you want to put your money in the bank just as it is when you can actually use it in property and make a lot more at the end of the day? All right, so this was our module for running the numbers. The next module we are looking at is to actually making it practical. So I want you to take a break and then hopefully I will see you in a moment or 2 or 3. Whenever you're ready, let's come back and then we will do the practical exercises of running the numbers. Talk to you soon.